you are waiting at a barber's saloon for your turn. To make your time useful, you're scrolling real estate listings like it's a competitive sport, and every house that doesn't appear from Stone Age costs around $450,000. The kitchen looks like it was remodeled during the early days of dial-up internet. The carpet is brown, aggressively brown, and soaked in mud. The basement has fake wood paneling that should have been illegal by now, and somehow the listing description confidently labels this masterpiece a starter home. And you wonder, is the price really $450,000 or is just $4,500? Did I misread? Sigh. So naturally you pause and do some mental math. Did I miss a promotion? Did everyone else get rich quietly while I was busy working? Or has the housing market completely abandoned logic and gone rogue? So today we're going to do something wildly unpopular with real estate agents everywhere. We're going to calculate who can actually afford almost $500,000 house in today's market. Not who the bank will approve after a quick glance at your credit score and a deep sigh, but who can afford it without turning their life into a long-term stress experiment. Because qualifying for a mortgage and living comfortably with that mortgage are two very different emotional journeys. Let's start with the part no one likes to talk about. $450,000 is now the average home price in the United States. Not luxury, not high-end, average. In many cities, that price gets you a modest house with 3 bedrooms, 2 bathrooms, and a yard roughly the size of a picnic blanket. In or anywhere near a major metro, this is considered completely normal, and we're all expected to nod along like that makes sense. Now let's bring income into the conversation. The median household income in the U.S. is about $84,000, which means the average American household is expected to buy the average American home at more than 5 times their annual income. If that ratio makes your brain itch, congratulations, you still understand basic math. But everyone keeps reassuring you. The mortgage broker says you're approved. Your parents remind you they bought their house on one income and vibes alone. Some guy on TikTok says houses always go up and somehow pay for themselves. So, what's the issue? The issue is that approved does not mean affordable. Those words are not friends. Let's talk about the down payment, where optimism goes to die. The traditional advice is 20% down. On a $450,000 house, that's $90,000 in cash. The median American savings account holds around $8,000. So unless you've been secretly stockpiling money like a cartoon villain, you're not close. You're not even warming up. And sure, you could save it. If you earn $84,000 and somehow manage to save 10% of your income, which almost nobody does, that's $8,400 a year. At that pace, you'll have your down payment in about 11 years, assuming housing prices politely freeze and wait for you. Which they will not. So most people do what actually happens in real life. They put down 5% or 10%. Let's say you manage 10%. That's $45,000 down, leaving you with a $405,000 mortgage. And congratulations, you've just unlocked PMI, private mortgage insurance. This is a monthly fee you pay because the bank doesn't trust you yet. It protects them, not you. And costs you roughly $200 to $350 a month for the privilege of not being wealthy. Now let's look at the actual mortgage. A $405,000 loan at today's interest rates, around 6.5%, puts your principal and interest payment at roughly $2,550 to $2,600 per month. Let's call it $2,560. And that's just the base payment. The house isn't done with you yet. Next come property taxes. Nationally, a reasonable estimate is about 1% of the home's value per year, which puts you at $4,500 annually, or about $375 per month. Homeowners insurance, with costs rising everywhere, expect around $250 per month if you're lucky. Maintenance, because houses enjoy breaking, another 1% per year, or $375 per month. Let's add it up. Your total monthly housing cost is now about $3,810. And that's the optimistic version of events. No roof issues. No vac failure. No surprise HOA projects. Just vibes. Now here's where the math gets spicy. Financial advisors suggest spending no more than 28% of your gross income on housing. Banks will approve you up to 43%. because technically you won't default immediately, which is apparently the bar. Let's reverse engineer this. If $3,810 represents 28% of your income, you need to earn roughly $163,000 per year to comfortably afford the average U.S. home. Even using the bank's much looser 43% standard, you still need to make about $106,000 annually. Only about 25% of U.S. households make that much, which means the majority of Americans cannot comfortably afford the average home price in America. That's not pessimism, that's arithmetic. So who's buying these houses? Some are dual income professionals in high-paying fields. Some have family help, and a very large number are stretching themselves to the financial breaking point and hoping nothing goes wrong. Let's look at a household earning $140,000 a year, well above median. After taxes and basic deductions, they take home about $8,300 a month. Subtract the $3,810 housing cost, and they're left with about $4,500. Then come car payments, insurance, gas, student loans, health insurance, groceries, utilities, and suddenly that buffer shrinks fast. By the time life finishes billing them, there's not much left for saving, investing, or breathing. This is what being house poor actually feels like. It feels like checking your bank account before grocery shopping. It feels like delaying car repairs and hoping for the best. It feels like lying awake at night, wondering how many things can go wrong before everything falls apart. At the median income of $84,000, buying a $450,000 house isn't tight. It's mathematically impossible without outside help or extreme risk. And yet, the system keeps nudging people toward it. Sellers price homes based on comps. Banks approve loans based on ratios. Agents encourage stretching. Nobody gets paid to say, this might ruin you. Once you buy, you're locked in. Selling is expensive. Moving is disruptive. Walking away destroys your credit. So people stay. They stay stressed. They stay stretched. They stay convinced this is normal adulthood. Here's the hard truth. For most Americans, the average priced home is no longer reasonably affordable. This isn't about budgeting better or skipping coffee. Home prices have risen far faster than wages for decades. The math hasn't worked in a long time. We've just been ignoring it. So let me say something radical. You don't have to do this. There is no prize for buying a house you can barely afford. No trophy for anxiety. No badge of honor for calling stress adulting. Real wealth isn't granite countertops. It's margin. It's flexibility. It's being able to handle life without panic. The real question isn't, can I get approved? It's, does this actually improve my life? If the numbers don't work, walking away isn't failure. It's clarity. The housing market will keep pretending these prices make sense. Banks will keep approving loans. Agents will keep saying it's a great time to buy. But you don't have to take on this madness. Think thoroughly, revisit your finances, and then make the decision. Remember, no one will come to help if you will be unable to pay the installment bills.